Hi everyone, we are from Group 1, consisting of Aminah Farhanah, Irsan Rabani, Jovan Ferdinan, Putri Adystie, Yuniar, Mulya, Riani, and Zefanya, Michaela. We are from Class A of Accounting Study Program, Faculty of Economics, Jakarta State University. Here we will explain the result of our work. We made a poster related to the material in accounting theory. In our poster, we titled the following relevance of financial accounting information. In the poster, we discuss about the definition of relevance of accounting information, the factor that influence it, relate matter, and its impact on creditor, investor, governments, and auditors. The first thing we will discuss is the definition of the relevance of accounting information. What is relevance of accounting information? The relevance of accounting information refers to the ability of accounting information to explain or represent the value of the company. This information is useful for users such as investor, creditor, and government to understand and make informed financial decisions.
The relevance of accounting information is dynamic and influenced by various factors, leading to changes over time. Apart from economic conditions, the relevance of financial information is also influenced by various other factors such as economic conditions, changes in standard, changes in policies, financial conservatism, earnings, equity, profitability, share ownerships, fixed asset revaluation, intellectual capital disclosures, tax avoidance, and corporate governance. For example, the implementation of PSAK 72 on revenue from contracts with customer makes not only earning per share but also book value per share relevant to stock prices. On the other hand, fundamental elements such as book value and consistent earnings have a positive effects on stock prices in the market. This shows that this information is very important for investor in assessing the value of a company.
The majority of accounting information items needed by decision makers, such as investors, creditors, government, and auditors, are found within financial statements, which are a consolidation of various accounting informations that accurately depict the company's true financial condition. These relevant items include earnings per share or EPS, book value of equity, and then there's liquidity, profitability, leverage, intangible assets, and the last one is sustainability reports. Earnings per share or EPS is a financial metric that represents the portion of a company's profit allocated to each outstanding share of common stock and provide an indication of profitability. The relevance of EPS can be demonstrated by an increase in EPS, which is usually followed by an increase in stock price. Besides EPS, a rise in stock price can also occur after an increase in the book value of equity. The book value of equity represents the total assets owned by the company minus its liabilities. So, an increase in book value of equity can indicate an improvement in the company's solvency and fair value. Next is liquidity, which shows the company's ability to meet its short-term obligations, and profitability measures the company's ability to generate profit relative to its revenue, assets, or equity. There's also leverage that indicates the extent to which a company uses debt to finance its assets. Intangible assets such as patents, trademarks, and goodwill represent the potential future value of a company that is not visible in physical features or physical assets. And then finally, the last one is sustainability reports that reflect the company's commitment to sustainable business practices. So, why exactly this information is relevant for decision makers?
The relevance of accounting information is useful for creditors. In the company business operation, sometimes the company borrows money from the bank for expansion, development, and other purposes. Bank decisions and lending funds to companies are based on accounting information. One of the items of bank consider is liquidity. Liquidity serves as crucial information for creditors in assessing credit risk. It indicates a company's ability to meet its short-term obligation. thus making it a valuable metric for creditors' evaluation.
Next is about the impact for investor. First, provide investor with insight into the company's profitability, liquidity, and leverage. Second, based on this insight, investor can make better investment choices because investor prefer companies that have high liquidity and profitability. Third, provides investor with insight into the company's financial risk. And lastly, investor can use this information to compare the company's performance with others company in the same industry. So by understanding this material, we know that investor can make better investment choices, and at the end this will have an impact on efficiency and transparency in the capital market.
Then, the relevant items in the accounting value is the sustainability report, and this report is useful for the government and auditors. Why is it useful? Because this report can reflect a company's commitment to sustainable business practices. These reports hold significant importance for both governments and auditors. Sustainability reports enable governments to evaluate the environmental and social impact of a company's operation, thus ensuring regulatory compliance and promoting sustainable practices. Also, on the other hand, auditors rely on sustainability reports to assess the reliability of financial statements, such as gaining valuable insight into a company's long-term viability and potential operational risks.
That's all the information on our work. We have discussed about the value relevance of financial accounting information. We hope the poster and the information we convey can be useful for everyone. Thank you.